Welcome to a special Economics. The minutes of the Monetary Policy Committee's August 10th meeting show that at least two of the external members, Dr. Ashima Goel and Dr. Verma, were a little more optimistic that the current food inflation spike can be looked through. Dr. Shashanka Bhide sounds a little more cautious. But many events have happened since they wrote their minutes and today. One, the July inflation number came after the minutes were written, and at 7.44%, they're much higher than RBI or the market forecast. Two, August rains have shown some El Nino impact, and they have pushed up cereals prices. Three, the RBI MPC members, Dr. Patra and Governor Das, have called for a tightening of liquidity. There was the incremental CRR. This has pushed up yields. And fourth, Jerome Powell over the weekend sounded more hawkish than expected about US inflation. So what are the current thoughts of the MPC external members? I have with me Dr. Jayant Verma, Dr. Ashima Goel and Dr. Shashanka Bhide. Gentlemen and Ashima, thank you very much for sparing time for us. Dr. Verma, let me start with you. Exactly the food inflation number at 7.44, indications are that August is going to be just as bad. Would you be a little more worried that food inflation may be sticky?
No, I think when we met, I think there was a fair degree of understanding that inflation these 2-3 months would be high. I think I was expecting somewhere between 7 and 8 to happen for a couple of months. So I think to me that did not come as a surprise at all.
Ashima, it's not just that the current quarter will not be 6.2, it's definitely going to be closer to 6.8 or thereabouts. Now that pushes the entire average also. I mean, the poll that we did shows that we won't be at 5.4, probably the average is going to be 5.6. So it's not just going to be a one-quarter affair from the way the market is reading it. Your thoughts, therefore, that probably would, if you're writing the minutes today, you would be more cautious?
Well, I think I was cautious enough. I said we have to watch incoming data.
Yes.
Therefore, our position will be affected by the kind of, the events you have underlined so well. But I think the key issue really is if this vegetable inflation reverses. Because, as you said, the average will go up only 0.2% for the year, average inflation. And if inflation reverses, then by midsummer it will be around 5.2, which suggests that our real rate is all right. So that is the key issue. And here I think we can expect some pleasant surprises on the supply side.
Okay.
For example, the China slowdown, we might see oil marketing companies passing through something. We might see further supply side action by the government. So I wouldn't base an outcome just on this last month or these 2 months. I would wait to see a little longer what other things happen before deciding that maybe food price inflation overall is going to be sticky for longer. And second, even if food price inflation is stickier for longer, cereal, pulses, etc., we still have some components that are falling, like palm oil, etc. And second, it's still something that might not affect the overall inflation because we're not seeing true second round effects, which is your wages must start rising. This is what happened in the really high inflationary period in the 2010s. Manufacturing wages, real wages are only half of what they were pre-COVID, and we're seeing employment softening, services employment softening. So this is when food prices affect wages and then affect food prices again, that it becomes truly persistent and generalized. We're not seeing that.
No, we haven't yet seen that for sure, but the food inflation has just begun. And if it persists, perhaps there will be demands for increases in DA. We also have an election round corner. So I agree that it would be wait and watch. Dr. Bhide, a similar question to you. You actually already sounded a little bit of caution when you said that, we should worry about broadening of inflationary pressures. Those were the very words you used. And now the data has come in worse. So would you have written the minutes differently? Would you have heightened your caution a bit more?
No, I think, obviously the first quarter numbers were very good that inflation rate was lower,
Yes.
but food as well. And so I think the concern was beginning with the problems with tomatoes and also July numbers. But I think the concern is there, I think, at least until September or so, because I guess this is about the time that the price rise in the case of food products, I think, particularly, there is more momentum and so on. So I think the El Nino effect or the uneven distribution of rainfall and so on, that doesn't sound very good for Kharif harvest, actually. So therefore, I think the concern is there as far as the food prices are concerned. But I think I would agree that in the case of non-food prices, the pressures, I think, are less. So that may be the reason that the overall headline inflation might still be moderate. So in terms of projections for the future, I think this quarter and the next quarter are going to be sort of difficult in terms of the food inflation is concerned. But I think the subsequent quarters, I think, would be more moderate than what we see now.
Okay. Well, we do see some international uncertainty also, and you point out to that, Dr. Bide, that there is also global volatility in agricultural commodities, and of course there is the hardening of crude prices. When you all were writing, we were not looking at a consistent $85, $84 for crude. Now that looks like the new normal. So, Ashima Goyal, the forecast we have of from the market for the first quarter or FY25 is not 5.2 as the RBI forecast, but 5.4. If it is 5.4, then 6.5 the repo rate minus the inflation rate of 5.4 will be only much less than what we thought. It's going to be 110 basis points. Are you okay with that?
Yes, I mean, I always said that that what I think is an appropriate real repo rate is 1% plus minus, because you can't hit it precisely. So we are still very much in that range. And I think that inflation targeting really works because they know the anchoring of expectations, because they know that the MPC is going to react if inflation rises persistently. And the real repo rate around 1% is giving you that reaction. Your nominal rate is matching the rise in inflation at present. So I think that is okay.
Okay.
That should work to anchor inflation expectations.
Okay.
And would be appropriate, because it's not so much that we are dampening demand. What is really important here, there is one other thing I want to say. I want to contrast our experience this time with what happened in the high inflation episode in the 2010. There, if you remember, after the global financial crisis, there was a huge stimulus which was not reversed for a long time. There was a huge liquidity infusion which was not reversed. Rates were raised in baby steps. This time, the reversion has been fast. We reach our equilibrium real exchange rate quickly. And the government is taking action. Then the government was spending a lot in rural areas on construction and so on, which increased demand for food, and already food inflation is high. And so you saw real rural wages rising. This time the government is spending to cap food prices, giving free food, buffer stocks, etc., as well as fiscal consolidation, reducing the fiscal deficit. So again, these are factors that will prevent that second round effect taking in. And overall, you would expect headline, which is volatile, to approach a more persistent core inflation.
All said and done, Ashima Goyal, the current general government deficit is still 6% plus 3%. It's close to 9%, probably 8.9. Not very different. At that time, the government definitely increased fiscal deficit, but we are not at a very low fiscal deficit at this point in time. It is just lower than what it was during COVID. But let me come to and you never know, it's in an election year, it might even rise. But that, I guess, is wait and watch for the MPC. Dr. Verma, you have never given us your idea of what is the neutral rate. Do you think a 1% positive real rate is enough? There were some RBI studies, I think, which were talking about 150 basis points. What's your view?
I think most estimates would be that, one should be somewhere in the range of slightly above 1. I would regard 1.5 as too risky.
Okay.
in terms of the growth impact. So I would be very worried about pushing it up all the way to 1.5. I would like it to remain significantly below 1
Okay.
and slightly above 1.
Okay.
1, slightly above 1. So between 1 and 1.25 would be my preferred zone
Okay.
for the
Your thoughts, Dr. Bide, on what should be the positive real rate?
I don't think I have a particular number. I certainly would like to have the inflation rate, projected inflation rates closer to the target that we have.
Oh.
I think that to me, I think that is an important point.
Okay. Okay, then I'll come back to that point in just a bit. That's very important. At 5.4, we are actually closer to the upper bound, if that's what the first quarter turns out to be. But Dr. Verma, the other thing that the Reserve Bank has done, which is not an MPC preserve, is the hike in the CRR. And Dr. Patra has gone hammer and tongs at how liquidity can fuel inflation. Now the call rate is actually closer to the upper bound, to the MSF rate. Your thoughts?
You see, liquidity management is a purely operational decision. It is the mechanism through which the RBI implements the monetary policy decided by the MPC, right? So if the market is not where the MPC is guiding it to be, then you tighten or loosen liquidity for that. So liquidity management is not a monetary policy decision, it's an implementation of a monetary policy decision. And that is an operational decision which the central bank takes, that if we want rates to be at the kind of level which the MPC has decided, then do we need to inject liquidity, do we need to take liquidity off? That's a purely operational decision. It is day-to-day management, which is nothing to do with the MPC.
Okay. Dr. Goyal, what would be your thoughts? I mean, the fact that consistently after the policy, the call rate has not been at the repo rate. It has been exactly 25 basis points higher. Everything, call rate, tripartite repo, all the one-day rates are at 6.75.
That's not correct. That's not in line with the MPC decision or with inflation targeting. Because inflation targeting mandates that the Reserve Bank must manage liquidity. All liquidity is supposed to become endogenous. So if the rates are higher than the repo, the Reserve Bank, the VRR short-term kind of liquidity adjustment should be such as to bring the repo rate down to bring the market rates down to the repo. So we should see that happening in the future. And I think that inflation targeting properly implemented should assure the market that we will not go into very large liquidity deficits. Excess large surplus liquidity as was there before the CRR hike can kind of leak into the informal sector or low interest rates and fuel. Earlier there used to be a fear of speculative food hoarding, etc. But I think when you're relying more on trade, that's not such an important issue. And you want to make speculation expensive by raising rates, not by...
Which is why I guess the Reserve Bank... Which is why I think the Reserve Bank has pulled out liquidity. You think that's fair?
Well, they didn't want too much surplus, so it was right to pull it out, but now they have to make sure that the market rate doesn't rise above the repo by injecting short-term liquidity. And if shocks are such, because in the economy you have outflows, you have intervention, etc., they can't do it through short-term liquidity, then they need to adjust the durable liquidity. But for a sustained period, the market rate should not be above the repo rate. That is mandated by the MPC.
Well, to be fair, it's only about 2-3 weeks that it is at 6.75. Nevertheless, it is. Two more questions remain. One, is growth consistently surprising on the upside, and what are their thoughts? And two, at what point would they talk about cutting? Those questions after the break. Welcome back to this special Economics. We are in conversation with the external members of the Monetary Policy Committee, Dr. Verma, Dr. Ashima Goyal and Dr. Shashanka Bhide. Gentlemen and Dr. Goyal, thank you very much for staying on. Dr. Bhide, you made that very important point that inflation, your outlook would be that inflation is not, when does it come towards the 4% mark? Considering that even in the first quarter of FY25, we are going to be, 5.2 according to RBI, 5.4 according to the CNBC-TV18 poll taken after the July inflation number. Do you think that pushes out rate cuts?
Yes, yes. I think as far as the projections are concerned, I think we're still looking at about 5%, or more than 5% inflation numbers for another 3 quarters, at least 3-4 quarters. So I think that is the concern that the committee has. And so we should be looking at closing in on the target without sacrificing a lot of growth. I think so. That is that's a concern. I do think that the downward momentum of the inflation rate has to be quicker than what we have seen so far.
Okay. Now, Dr. Bhide, when you will get the next forecast, probably, earlier than April, about the second quarter of FY25, that's bound to be close to 4% or thereabouts because you have a very high base. The July, August, September of this year is going to be 6.8 or 7. So the base is going to make the forecast lower. Will that suffice for you to move? I mean, the forecast itself being closer to 4 will be enough to cut rates? Or do you think, given the volatility, that won't be enough? Dr. Bhide, your thoughts?
No, I think probably the higher numbers that we see now are also affected by sort of somewhat lower base, I think,
yes.
At least for the second quarter and so on. So I think the base does matter, but at the same time, I think consistently getting the inflation rate lower than 5%. I think that would be that would give me more confidence. I think that we are closing in on the target.
That's my point, Dr. Verma. Considering that forecasts are all over the place because of uncertain events, whether it is China or whether it is Ukraine. Do you think just the forecast of 4%, something is enough to cut rates? What would you look to ask for a rate cut?
No, I think nobody is looking at a rate cut right now.
Yeah.
And we are really looking at keeping the restrictive monetary policy until it brings inflation down. And I'm very clear that one quarter does not make any difference. One quarter of low inflation does not make a difference. One quarter of high inflation does not make a difference, right? So in the last meeting, I said it is premature to declare victory. And in this meeting, I'm saying it is premature to declare.
I saw that, yes.
So it is the same thing. If you tell me that one quarter we will have inflation, that changes nothing for me. Okay. So what we are looking at is bringing inflation down on a sustained basis and clearly seeing a glide path towards the target. Okay. That is what is required, and that is where monetary policy should be acting.
Okay, Ashima, your thoughts on when and what you would watch out for rate cut? Because very clearly, when the next forecast comes, maybe it will come in October itself, or RBI will give that forecast in December. But there is a 4 number coming. Would that suffice for pushing for a rate cut?
No, because we look at 1 year ahead, which is more immune to these measurements and base effects or average over the year, so on, right, to overcome these base effects. But I think I want to emphasize that we are in a flexible inflation targeting regime. And our forecast before the Ukraine war broke out and after all the pandemic supply chain shocks, etc., was 4.5%. We were well on our way to our target. Then the war. And if you are in a flexible inflation targeting regime, the mandate is that you accommodate supply shocks. You don't let that lead to a knee-jerk reaction that can derail growth. So a flexible regime, that's why we have those 3 quarters, that's why we have those bounds. They're meant to be used in such circumstances. If you don't use the flexibility now, when will you use it? Okay. And we must give credit to overall macro policy that India's growth is kind of, recovery has been good and growth has been resilient because of smoothing shocks rather than overreacting to shocks and aggravating them. That's very, very important. So overall, I think for when we will cut, I said that a real repo rate of 1%. So on a sustained basis that's approaching 4, then our current repo becomes too high. And so before we reach 4, maybe we would need to cut. But that is if we are confident that it is sustainably moving towards 4%.
Okay. Well, I'm not able to do the quick math, but I think in your term, of the three of you, CPI has been closer to 4% only, I guess, about 5-6 months. For a seriously large part, it has been between 5 and 6. But to be fair, it's been both a period of Ukraine and COVID, so things have been all over the place. Dr. Bide, you make a very important point in your minutes that the IMF has upped the global growth forecast. For 2 quarters in a row, U.S. growth has surprised on the upside. And surprised hugely on the upside. Instead, from an expectation of 1.8, it came in at 2.4% for the first quarter, and likewise even in the second quarter. A huge upside. Our forecast for Q1, that is calendar Q1 or Q4 FY23, expectations were 5.1. It came in at 6.1. For the full year as well, there was an upside. Growth is actually surprising of the upside. So is that also something we should worry about as aggregate demand likely to push up inflation?
I think there are also, it's a mixed picture as far as growth is concerned. I think, so it is true that there have been upgrades on growth, I guess, globally. But I think the China story, I don't think was fully captured even in that upgrade. So besides that, I think even in the domestic economy, I think the concerns are there on consumption also. So if the impact of higher or the impact of this El Nino and so on are there, that might affect the rural demand also. So I think that the first quarter growth is expected to be strong. There is also a bit of this catch-up in what happened in 2020. But I think going forward, that is where we should be looking for stable growth. So I think the growth patterns, as far as present trends are concerned, they still show a mixed picture.
Okay, just the same question to you, Dr. Verma, and a final question. Is growth actually consistently surprising on the upside, both in India and abroad? Crude prices are not coming down, indicating some demand. China is also, even the latest news is that they are pumping up stimulus measures. How do you see the global mix? Powell also pointed out that growth and labor market is surprising on the upside.
I think the question to ask is, where do we stand in relation to potential outcome? And the way you look at it is, what has been the average growth from 1920 onward? What has been the compound annual growth from 1920 onward? And how much of growth catch-up is still there? So if you take the view that you are already in potential growth, then that's a different story. But I don't think so. If you look at average growth from 1920 onward, I think we are well below the trend line still. There is a lot of growth catch-up to be done. And these numbers, good as they are still showing us, in my view, well below potential output.
Okay. Yes, the potential output also is up for discussion, but that discussion on another day. Thank you very much, Ashima Goel, Jayant Verma, and Shashanka Bide. The key takeaway, yes, members are worried that inflation shouldn't be broadening. They are at the moment not thinking of cutting at all. That's important. But the third key takeaway for me is that the neutral rate or the positive real rate, at least 2 members want it to be just 1 percentage point. That's interesting. Thank you very much for watching this edition of Economics.